EPS from Pepsico beat expectations in the latest quarter. Investors, though, are anxious to see signs of a turnaround in sales in the North American beverage business. Of course, PepsiCo, gigantic. It owns Lay's, Gatorade, and Quaker brands, among others. Let's get more now from Filippo Falorni, Director, U.S. Beverages, Household Products and Personal Care, Lead Analyst at Citi. Thanks very much, Filippo, for joining us. What jumped out for you with the Pepsi numbers, please?
Hi, Andy. Thanks for having me on. Yeah, look, I mean, the organic sales numbers were still pretty soft this quarter. They posted 1.3% growth. That was mainly driven by pricing, though. Pricing was up over 4% versus volumes were still down 3%. To your point, the focus has been really on the North American results because those are being the weakest within the company. And the weakness has been pretty pronounced in the Pepsi Foods North America business. That's where the snacking part of the business resides. Fritos, Doritos, Tostitos, Lay's. That business was down 3% in organic sales. So that remains a pressure point. The beverage business, on the other side, started to see some improvement in this quarter. They were up 2% in organic sales. And then international continues to be the relative bright spot for the company. It was up over 4%, still the best performing across all their segments.
I'm just looking at the stock over the past year, as of today, down about 20%. The S&P Consumer Staples Index down about 2%. Why have investors been cool on PepsiCo over the last year?
Yeah, no, that's a good question. I mean, look, the main pressure has been on the Pepsi Foods side, as I mentioned before. Mm-hmm. That's where investors are worried about the more structural demand headwinds that business is facing, especially with consumers being healthier, focusing more on reducing calories and fats and sugars and salt, and also the impact of GLP-1 drugs, right? Like clearly snacking is one of those particular occasions that under GLP-1 is clearly negatively impacted. So there are some concern of the long-term growth trajectory of the foods business, particularly the Frito-Lay side. And look, Pepsi is trying to do what they can in terms of bringing new innovation to the market with a focus on protein. That was a big focus today on the earnings call, all their protein innovation, both on the snacking and the beverage side. And so they are trying, but obviously the market is a little more skeptical on the long-term growth of this foods business.
That's interesting. And so protein, what are they going to be adding? I guess they'll be adding peanuts and stuff like that to their snacks. Peanuts, a cheap source of protein.
Well, some of it is like protein chips within their platform. And then today they also announced a significant lineup in the beverage side. So they're relaunching the Muscle Milk product that they bought a few years ago. They also launched a new product with Starbucks ready-to-drink coffee, including protein. And then Propel, which is their sport drink brand. They're launching a protein powder that can be mixed with water and provide protein needs especially for consumers on GLP-1. So they're really trying to innovate in that particular part of the business. Obviously, it will take some time for this innovation to materialize in better sales results.
So Pepsi stock down about 20% in the past year. Coca-Cola is another stock you follow. It has held up better in the past 12 months. It's down about 5%. You have a buy on PepsiCo. What is your take on Coke, please, Filippo?
Yeah. I have a buy rated on both. I prefer Coca-Cola between the two. Coca-Cola, first of all, it's a 100% beverage company versus Pepsi is actually more of a snacking company, 60% snack, 40% beverages. And for Coke, look, the beverage business has performed better than Pepsi both in the US and internationally. Coca-Cola also have a bigger exposure into emerging markets where growth has been over the last year or so has been clearly a lot stronger compared to the US. And even within the US, the Coca-Cola brand has been gaining share within the market at the expenses of Pepsi. So overall, as a company, in terms of underlying performance and growth outlook, Coca-Cola clearly has been outperforming and clearly doing better than most of their peers in the beverage space.
Finally, Keurig Dr. Pepper, those shares have suffered in the past year, down about 30%. What's your rating there, Filippo?
Yeah, look, I'm a buy rated on Keurig Dr. Pepper as well. I mean, the issue there has been mainly around the acquisition that they've announced in late August of JD Peet's, which is a coffee asset. The market really didn't like that acquisition. KDP, the prior company, was really focused on half of it, more than half on carbonated soft drinks with the Dr. Pepper brand, and less than half on the coffee side. After this acquisition, they're really doubling down on the coffee side, which is an area that has been under pressure, both from a volume standpoint, but also from a commodity cost standpoint, given the rising coffee prices. Now, the company has announced plans to split into two companies after the acquisition closes, a beverage company and a pure play coffee company. So I think there'll be probably more interest after the split, especially on the beverage company, because the Dr. Pepper business is performing pretty well. The problem from an investor standpoint is that the coffee side has been under pressure, and the company decided to really double down in coffee at a pretty challenging time for the category.
Filippo, thanks very much indeed. Filippo Falorni, Director for U.S. Beverages, Household Products and Personal Care, Lead Analyst at Citi.